Navigating a stock market downturn can be daunting, but your response can significantly impact your financial future. Market crashes, marked by sudden drops in stock prices and mutual fund NAVs, are often unexpected. In this video, we will share 10 practical strategies to help you effectively manage a market crash and capitalize on potential opportunities. Are you ready to turn challenges into advantages? Let's explore these strategies. Welcome to holisticinvestment.in. First, anticipate market crashes. It is essential to understand that market crashes and sudden declines are inherent to investing. A market crash refers to a rapid and steep drop in stock prices, typically exceeding 20% from recent highs. These events often happen unexpectedly and can be triggered by various factors such as economic downturns or geopolitical issues. For instance, at the start of 2020, most were unaware of looming pandemic, yet by mid-year, major markets had fallen by over 30%. As Warren Buffett wisely stated, if you stick around long enough, you will see everything in markets. So, how can you prepare for these inevitable fluctuations? By adopting a mindset that anticipates volatility, you can respond more calmly when downturn arises. Next, avoid margin buying. A critical principle to keep in mind is to avoid buying securities on margin. Have you thought about the risk associated with borrowing money to invest in stocks? While margin buying can amplify gains in a rising market, it also poses significant risk during downturns. In a declining market, margin buying can lead to greater losses. When prices drop, you could end up with negative equity and struggle to meet interest payments. This scenario could force you to sell at a loss. Instead, consider focusing on investing only with your own capital to protect your financial health. Next, establish your financial safety net. Emotional investors often panic and make rash decisions to sell their holdings at the worst possible times. How can you avoid this fate? A key strategy is to maintain adequate liquidity and savings to cover your expenses without having to liquidate investments in a down market. This approach allows you to avoid crystallizing losses and stay invested through market fluctuations. Building a financial moat is vital. It involves creating a safety net that covers 6 to 12 months worth of living expenses. This cushion can protect you from pressure to sell investments during downturns. History has shown that economic crises such as the COVID-19 pandemic can lead to job losses and business closures, affecting your income and financial stability. Having cash reserves ensures you won't be forced to sell at unfavorable prices. Think of this safety net as your buffer against unexpected financial challenges. Next, adopt a business owner mentality. Have you ever viewed your investment from a business owner's perspective? When you invest in stocks or equity mutual funds, you are essentially acquiring a stake in a company. By adopting the mindset of a partial owner rather than a speculator, you can shift your focus from short-term price fluctuations to the fundamental value of your investments. As Ben Graham famously said, the market is there to serve you, not to instruct you. It is time to focus on the long-term performance and potentials of the companies or mutual fund schemes in which you invest. Instead of being swayed by daily market movements, concentrate on the underlying business and its growth prospects. This perspective can help you make more informed decisions and stay committed to your investment strategy even when market volatility tempts you to act impulsively. Next, invest with a business mindset. Prioritize fundamentals. When assessing your investments, are you concentrating on the health and the performance of the underlying businesses rather than just their stock prices? It is crucial to remember that while a company's stock price may fluctuate, a strong business can still offer a positive long-term outlook. How do you determine if a company is a worthy investment? Look at key indicators such as revenue growth, earnings stability, balance sheet strength, and management quality. Similarly, when investing in mutual funds, prioritize the quality of the underlying assets and the fund manager's track record. Even if short market volatility affects NAVs, well-managed funds with solid fundamentals are more likely to deliver long-term growth. Think of investing like purchasing an apartment. Would you obsess over its market value every day? Instead, wouldn't you prefer to focus on its overall quality and income-generating potential? By maintaining this perspective, you can navigate market volatility with greater confidence and clarity. Next, invest in companies with strong balance sheets. Have you considered the importance of strong balance sheet in your investment decision? During market downturns, companies with low debt and solid financial health are better equipped to endure economic challenges. The same principle applies to mutual funds. Those invest in financially stable companies tend to be more resilient during turbulent times. By focusing on businesses or mutual funds that invest in companies with strong balance sheets, you not only mitigate the risk of severe losses but also position yourself to benefit when these resilient companies recover. Next, seize investment opportunities in lower prices. Are falling stock prices and mutual fund NAVs leaving you feeling discouraged? While they can be disheartening, they also create unique investment opportunities. When prices decline, it is a chance to acquire shares and mutual fund units at more attractive valuations. The key is to differentiate between temporary market dips and fundamental changes in a company's or fund's long-term prospects. If it is a temporary market dip, then lower prices can be viewed as an opportunity to buy more shares at discount. This approach allows you to transform potential setbacks into rewarding investments. Next, diversify your investments, essential for risk management. Diversification is a fundamental method for mitigating risk. By spreading your investments across various sectors, industries, asset classes, you can minimize the impact of a single investment's poor performance on your overall portfolio. Take the COVID-19 pandemic as an example. Travel and airline stocks were hit hard, but wouldn't a diversified portfolio with holdings in other sectors have helped cushion the blow from such downturns? By creating a well-diversified portfolio, you can navigate market volatility more effectively. Next, stay calm and adhere to your plan. Have you thought about how a well-structured plan can make a significant difference during a market crash? Establishing a clear strategy for responding to market declines, whether it involves buying more or holding steady or reassessing your investments, can provide clarity and help reduce stress. Isn't it inspiring that some of the best investors like Warren Buffett and Peter Lynch often take advantage of market volatility? They prepare in advance by building cash reserves and identifying potential investment opportunities. By having a plan in place, you can maintain focus and make rational decisions even when the market is noisy. Next, stay informed but don't overreact. While it is essential to stay updated, overreacting to daily market news can lead to impulsive decisions. Concentrate on the bigger picture and your long-term strategy instead of reacting to short-term fluctuations. Staying calm and informed will enable you to make better decisions during a market downturn. Here is our final takeaway. Market crashes can be intimidating, but they also represent unique opportunities. By anticipating volatility, avoiding margin buying, and maintaining a financial safety net, you can protect your investments. Adopt a business owner mindset, prioritize companies with strong balance sheet, and diversify your portfolio to manage risk effectively. Having a solid plan will help you remain calm and informed during turbulent times. Are you ready to turn challenges into profitable opportunities and shape your financial future? A detailed blog post on this topic is available on our website and the link is given in the description.
And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.